All right, we are live. Hello there. I'm Mitch Goldberg. Guess what time it is? Well, it's well past 4:30, but you know the deal. Let's get to camera one. It is time for Be the Boss of Your Money. It's my live stream. I do this daily to explain markets, to explain finance, to educate you and share with you my knowledge of 30 plus years as a financial advisor to individual retail clients, that's you, so that you could make hopefully better decisions. And one of those decisions that you need to make is the decision to do nothing, right? I'm here to help make you the best possible financial version of yourself, right? You need to be the best possible financial version of you. That's worth fighting for. It's worth doing something about. It's worth taking the time to do this live stream. And therefore, I hope it's worth it to you to take the time to watch because it's for you. By the way, if you have a suggestion, something I should do to improve the live stream, a topic of conversation, a guest you'd like to see, maybe an expert in a particular field, what field is that? Please let me know in the comments. And if you have any questions about personal finance, borrowing, lending, markets, stocks, whatever, please hit me up in the comments. I love hearing from you. It's the best part of doing this. You'll make my day. And while you're watching, please give it a thumbs up or a heart or a wow, whatever reaction is available to you, depending on which social media platform you're watching on, because that is always a lot of fun. And just to show you which platforms that I'm on, you can check me out on Instagram, YouTube, Facebook, LinkedIn, Twitter. I'm most active on LinkedIn, just so you know, but I'm active on all of these channels. I post almost daily, but I really get into sharing deeper thoughts, on LinkedIn. Well, actually, Facebook too, all of them, but Facebook, that's where I post a lot of personal stuff as well. In any event, the Federal Reserve is raising rates. And the Federal Reserve said something today that you would think would crush the stock market, that would kill the rally, that would set us right back to new lows. And that thing, you know what, let me just run to the intro first, and then we're going to talk about this stuff because it's important to know. It's important to know what the Fed said because it's like, right now, it's everything. Here we go. All right. Thank you so much for joining me. Let me know how I'm coming out. Make sure you can hear me just fine. About a month ago, I did a whole live stream, and I found out after the live stream that there was no audio. I could hear myself talk, but you couldn't hear me. So let me know if you can hear me. And again, give me a thumbs up or, whatever reaction is available to you on whatever platform you're watching on. And this way I could see who's out there, give you a shout out. It's always fun. And I love to answer your questions and you know, any words of wisdom, words of encouragement are always appreciated. Or just say hi in the comments. Okay. The Federal Reserve said that it will raise rates substantially, significantly, if it has to, in order to bring inflation down from currently 8.5% on the CPI, the Consumer Price Index. Get this, all the way down to 2%. That is a lot. I mean, now I'm not saying that prices are automatically going to go down 2%, down to 2%. I'm not saying prices are going to drop 6.5%. It's the rate of change. In other words, we are right now in August. So if prices in August of 2022 only go up 2% from where they were in August of 2021, mission accomplished. Generally speaking, prices go up. There are a few things to know about inflation. The first and foremost thing that I want you to know, and I really want this to like sink in, I don't think this concept is thought of enough. Okay, so I'm not trying to minimize. By the way, I see Gus just became a new subscriber to my YouTube channel. Thank you, sir. Greatly appreciated. Here's the thing about inflation that I want you to know. Yeah, we're paying more for everything. Okay. But we are also seeing price declines in a lot of things. And how does that work? So just humor me for a second. I really want to explain this the best I can with without clearing my throat into the microphone. And I want to explain this concept. I want to explain this concept in a way that does justice to the pain and suffering that we're all feeling with regard to the current inflation situation. When you think about our economy, it's a very tech centric, digital, information based economy. And computing power has been getting cheaper and cheaper. Okay. Computing power has been getting cheaper and cheaper. Now, a little dry. It's one of those days where I can't get rid of that cough. So I see somebody out there who's out there. Michael Rosenberg. What's up, buddy? So glad you could join us. All right. So we're a digital economy. Paul Volcker gets credit for bringing inflation down around 1981, 82. Okay. What he did was he jacked up interest rates to crush demand, to bring inflation down, to bring prices down. All right. And he sent the economy into not one but two recessions. The recessions were pretty tough, but there were other things going on. So about those recessions in the early 80s, and this continued throughout the 80s. Manufacturing, auto manufacturing, steel plants, massive job losses. We started to see Rust Belt cities, become economically destroyed. All right. But that would have happened anyway because American manufacturers figured out that they could easily make products that could send their manufacturing overseas. And that is the cause of the early onset recessions of the 80s. Okay. But the other thing that brought down inflation, and I think this is the reason why inflation came down. I know people keep saying Paul Volcker raised interest rates, crushed the economy. If you think about it, the PC for office use came about around 1980. It's when the PC started to go into people's offices. And by 81, 82, the PC, the personal computer, was such a massive shift. It was such an incredible boon to productivity. And when we had more productivity, humans getting way more stuff done, that's what brought inflation down. I venture to say the Federal Reserve didn't have to jack up interest rates so much. It was the computer, the PC, the mass adoption of PCs in corporate America and then into people's homes in the 90s, and then the internet. Okay, that is what brought inflation down. We still have that. Now, we can't eat computers. We can't eat ones and zeros. I understand. So don't be a wise guy and say, oh, well, what about that? All right. No, you can be a wise guy if you want. Go ahead. All right. I'm not telling you what to do. You want to be a wise guy? Be my guest. Stacy's out there. Hey, Stacy, thank you so much for joining me. I digress. Stacy, thank you very much. The our economy now is more digitized than ever. So I look at things like gold, and I look at things like interest rates on treasury securities, in particular the 10-year treasury. And these, for the longest time, have not been shouting inflation. Everybody's shouting inflation, and I'm not belittling inflation. There is inflation. Prices are up. But it's not reflected in the usual suspects, gold and treasury securities, meaning interest rates, long-term rates. And I think there's something going on here that we need to talk about. Inflation is probably going to come down. Inflation in goods and services is not as big of a deal as it was in the 80s when inflation was much higher, because all you hear now is inflation's at a 40-year high. That's 1982 from now, 2022, because we weren't as digitized back then. If you think about cloud computing, companies moving all of their information, computer services, and power to the cloud, to Amazon Web Services, Azure, which is IBM, Google Cloud. The cost of running businesses and remaining efficient is still coming down. Yes, I know an iPhone is over $1,000 today, but what you get in an iPhone today makes you so incredibly efficient. And I think when you take into consideration how digitized we are, this is why the stock market has been able to rebound since its June low of this year. This is why interest rates, in particular the 10-year yield, which is still under 3%, has not spiked up to 5 or 5.5%, which is what you'd expect with inflation running at over 8% by now. And it's why gold isn't going up, because inflation today is not the same as it was 40 years ago. It was much worse 40 years ago. But because of digitization, because of how much more computing power that you get for your buck, it's really a remarkable, remarkable thing of what technology is doing for inflation. This started in 1980 with the invention of the PC, with the PC being introduced to the office environment, and it continues more and more and more. Let's see who's out there. Mike says hi. Yep, thank you for following directions, right? Mike, thank you so much. Nice to see you, my friend, and I've been enjoying all of your terrific summer vacation pics. Enjoy. I love seeing it. Let's take a look at how the market did today. Yeah, but last thing on inflation. The Fed said something that they're going to keep raising rates to get inflation down. And the market was down like over 300 points in the Dow at one point. It was down like 178. Well, it was down. How much was it down? The Dow was down 171 points. Well, I'll show you the numbers in a minute. It's not really relevant for what I'm trying to say. But the Fed said we will do what it takes basically to bring inflation down. Do you feel, or at least you might not feel, but investors do feel, that the Federal Reserve now has taken control of this situation? This is comforting to investors, that the Fed has a handle on things and is willing to do what it needs to do to bring inflation down. That's bullish for the market. If the Fed didn't raise rates yet, certainly inflation would probably be higher, but investors would be terrified of runaway inflation that would last for a very long time, very, very long time. That would be a destroyer of financial assets, it would be a destroyer of wealth, it would be a destroyer of the economy. it would be a destroyer of the economic future of our country. But the Fed's in control now. And that is just so incredibly comforting. And they also did say that they are willing to pull back on raising rates if they reach their target, or they see that their target is going to be reached without more rate hikes. We don't get a better thing than this. Okay. Phil says, interesting take on inflation. Have to think about that for a while. Certainly some valid points. Hey, thank you very much, my friend. Phil, thank you. Thank you so much. Yeah, it's they're valid points. And this is also why inflation isn't felt evenly, because people who are living not as attached to technology, whose lives are not as digitized, could be feeling the effects of inflation more. It remains to be seen, and a lot of what we're talking about will have to be proven over time, I guess, right? All right, now let's take it to the boards. Let's take it to the big board. Okay. Put myself up here. So the Dow down 171 points, NASDAQ down over 1%, but it's been up a lot also. S&P off 31 points. Not a disaster. Gold down 12. We are just talking about that. Still in the 1700s. Oil up 98 cents, but it was down like $4 yesterday. So, wasn't it just 130 and people were calling for 150, 200? Now it's 87. Now there's forecast it'll go below 60. So, when it goes up, people get the most attention in the media when they have big bold calls to the upside. When it goes down, people get attention who are calling for more downside, I guess. That's the way it works, right? The 10-year at 2.9%, up a little bit, but I don't think it's a meaningful change from 2.7 or 2.8 to 2.9. Maybe mortgage rates will jump up a little bit, but mortgage rates have come down back to the low fives, in some cases high fours. But mortgage demand still is not going up. There's a shortage of houses. It's really not for demand. It's for, there's just not enough houses. VIX is still under 20. I think that's a bullish sign. Let's take a look at the yields. 3.29 on the 2-year. 3.29, and we're 2.9 on the 10-year. So we continue to see an inverted yield curve, which is representative of low confidence in the economy, or a belief that the economy is going to slow down. Certainly a belief that the Fed is going to keep raising rates, and a belief that inflation is on its way to coming back under control. It all, to me, lines up. And this is why I'm not making crazy snap decisions and just completely reconfiguring client accounts. You hear it all the time. You should go all into TIPS, Treasury inflation protected securities, which have done horribly this year. And then you should all go back into 100%, value and dividend stocks. But then you should go back into all growth stocks. I really don't like these all or nothing calls in the market. And I have my own views of where stocks are going higher over time. But for those of you who are on the cusp of retirement or in retirement, I don't want you to go by anyone's views. I want you to go by how much you have in stocks, bonds, cash. What's your spending needs? What do you have in cash to handle that over the next 2 or 3 years to get you through a bear market or recession? Make sure you're not overly invested, because you don't want to have a sequence of negative returns. And just basically smart personal finance is what's going to get you through anything. That's what we're doing. I always like to give you the statement, though, all right? Markets have always recovered. There's never been a market that hasn't gone up, back to new highs and make new highs after that. But individual stocks don't always recover. So that's why there's a little confusion when people are down in stocks and they have lots of individual stocks. People say, oh, don't worry, the market always recovers. But that doesn't mean the individual stocks recover. So you have to know what kind of investor you are. Maybe you don't belong in individual stocks, but making that decision, coming to that conclusion, will do much more for you over time than trying to decide if the stock market has another 5% to the upside or downside over the next 30 days. With that said, I'm going to get going. I will be back Monday. I'll be in tomorrow. And if something crazy happens in the market tomorrow, I'll definitely be in the live stream. But generally speaking, if nothing crazy happens, I take off every Friday from the live stream. And that's about it. Thank you, guys. Thanks, Mike. Thanks, Phil. Thanks, everyone who's out there watching. And I will speak to you soon.